Hey everyone, and welcome back to the Safe Simple Sound podcast. I'm your host, Alex, and I'm thrilled to have you join me today as we decode a crucial aspect of your financial well being, your income. To make sure we cover this important topic thoroughly and in a way that's easy to understand, we've broken down today's episode into 4 key sections. First, we'll tackle understanding gross income, what counts. Next, we'll move on to tax exclusions, what doesn't count as income. Then, we'll walk through the income tax formula, a step-by-step guide. Finally, we'll wrap up with calculating and reporting your gross income. So, get ready to embrace mastery of cash flow, as we say here at Safe Simple Sound. By the end of this episode, you'll have a much clearer understanding of your income, how it's taxed, and the steps you can take to ensure you're on the right track. Let's dive in. You might be thinking, Alex, isn't income just, my paycheck? Well, yes, but it's also so much more than that. Understanding your gross income is the very first step in calculating your taxes, and it's surprisingly broad. The IRS essentially operates under the principle of income from whatever source derived. Think of it like this. If you receive something of value, whether it's cash, a service, or even property, it's generally considered income. It's like if you cleaned your neighbor's yard and they baked you cookies in return. Those cookies, in a tax sense, represent income, the fair market value of those cookies, to be exact. So let's break down what that whatever source derived really means. First, we have the obvious, wages and salaries. This is the money you earn from your job, reported on your W-2 form. But gross income goes beyond that. Think about those year-end bonuses. Yep, that's income. Got an award at work for outstanding performance? That's income too. Then there are taxable fringe benefits. These are the extras your employer provides that have a monetary value. For example, if your company gives you a car to use for personal reasons, the value of that personal use is considered income. Or if your employer provides you with group term life insurance coverage exceeding $50,000, the cost of the coverage above that threshold is included in your income. Other common employee income sources include tips, sick pay, and even the fair market value of notes received for services. Let's talk about something called bartering. Remember our cookie example? That's bartering. You provided a service, cleaning the yard, and your neighbor provided goods, cookies in return. The IRS considers the fair market value of the goods or services you receive in a barter exchange as part of your gross income. So, if you're a freelance graphic designer and you trade website design services for, say, a year's worth of haircuts, the value of those haircuts is taxable income. Now, I want you to take a moment and think. Can you think of any income you've received that you weren't sure was taxable? Maybe a gift from a client, a prize you won, or even a side hustle you haven't fully reported. How can understanding this broad definition of income from whatever source derived change your perspective on your finances? It's all about being aware and making sure you're accurately accounting for everything. And that brings us to those all-important tax forms, your Form W-2 and any 1099 forms you might receive. Your W-2, which you get from your employer, summarizes your wages, salaries, and other compensation, along with taxes withheld. 1099 forms, on the other hand, report various types of income you might receive from sources other than your employer, such as freelance work, 1099 NEC, interest, 1099 INT, or dividends, 1099 DIV. These forms are your roadmap to understanding your gross income for the year. So, to recap, gross income is all income you receive from any source unless specifically excluded by law. It includes your wages, salaries, bonuses, tips, taxable fringe benefits, and even the fair market value of bartered goods or services. Understanding this is crucial for accurately calculating your taxes. Your call to action for this segment is simple. Gather your W-2 and any 1099 forms you received this year. Start identifying your various sources of income. This is the first step in taking control of your tax situation and ensuring you're on the right track. Now, let's flip the script a bit. We're going to talk about what doesn't count as income, and these are called tax exclusions. Think of it like this. You've got your big bucket of gross income, everything you've earned. But before the IRS starts calculating your tax bill, they let you take some things out of that bucket. These are your exclusions, and understanding them is crucial for accurately determining your taxable income. So, what exactly are tax exclusions? Simply put, they're specific types of income that the tax law says you don't have to include in your gross income. They're essentially free passes from taxation, which is pretty great, right? It's important to distinguish this from your gross income. Your gross income is all income from all sources, while tax exclusions are specific items that are removed from that total to get you closer to your taxable income. Let's dive into some common examples, especially those relevant to you as employees. One of the biggest ones is employer-provided accident and health plan benefits. If your employer pays for your health insurance premiums, that's generally not considered part of your taxable income. It's a huge benefit, and the IRS doesn't tax you on it. Similarly, if you're reimbursed for medical care expenses, that reimbursement usually isn't taxable either. Imagine you have a hefty medical bill, and your insurance covers part of it, and your employer's plan covers another chunk. That reimbursement from your employer isn't added to your income. Another example, specific to a certain profession, is housing allowances for members of the clergy. Often, the rental value of a home provided to a clergy member or a specific housing allowance they receive isn't included in their income up to the reasonable pay for their services. This is a special rule recognizing the unique circumstances of their work. Now, here's a really significant one. Veterans benefits. If you're a veteran receiving benefits under any law administered by the Department of Veterans Affairs VA, those benefits are not included in your income. This is a way of honoring and supporting those who have served our country, and it's a substantial tax exclusion. There are other exclusions too, like certain life insurance proceeds. If you're the beneficiary of a life insurance policy, the money you receive often isn't taxable. Also, certain welfare and other public assistance benefits typically aren't included in your income. We won't go into exhaustive detail on every single exclusion here, but Chapter 8 of the IRS Publication 17, which we'll link in the show notes, provides a comprehensive list. So, why does all this matter? Well, think about it. Why do you think the tax code allows for these exclusions? It's often about fairness, encouraging certain behaviors, like employers providing health insurance or recognizing specific circumstances, like the sacrifices of veterans. And crucially, how can understanding exclusions help you potentially reduce your tax burden? Well, by knowing what doesn't count as income, you can ensure you're not paying taxes on money you shouldn't be. It's about accurately calculating that taxable income figure, which is the foundation of your entire tax calculation. For example, if you mistakenly included your health insurance premiums paid by your employer as part of your income, you'd be overstating your income and likely overpaying your taxes. Knowing the rules prevents those kinds of errors. So to recap, tax exclusions are specific types of income that are exempt from taxation. They're different from your gross income, and understanding them is key to accurately determining your taxable income. We covered employee benefits, clergy housing allowances, veterans benefits, and briefly touched on others. The IRS may have exclusions that would affect your wages and salaries, so taking a look at the exclusions is paramount. Your call to action for today is this: head over to the IRS website or check out the resources we've linked in the show notes and review the information on tax exclusions. See if any of them apply to your specific situation. It might just save you some money. We've just tackled the basics of gross income, basically all the money coming your way. Now, let's get to the heart of how that income actually gets turned into the number that matters most for your tax bill: your taxable income. We're going to break down the income tax formula step by step, and trust me, it's less intimidating than it sounds. It is one of those income tax basics you need to know. Think of it like baking a cake. You start with all your ingredients, your gross income. Then you start refining it. That's essentially what the tax formula does. It takes your gross income and, through a series of steps, whittles it down to the amount the government actually taxes you on. The basic formula looks like this: gross income minus adjustments equals adjusted gross income, or AGI. Then, AGI minus deductions equals taxable income. Finally, your tax owed, or your tax liability, is determined, and your tax credits are subtracted from that tax liability, which will determine your total tax. Let's walk through it. First up, we've already covered gross income. That's everything. Your salary, tips, freelance gigs, even that prize money you won in the pie eating contest. Next come adjustments. These are specific things the government lets you subtract before you even get to the main deductions. Think of them as above-the-line deductions. Common examples include contributions to a traditional IRA, student loan interest payments, and health savings account HSA contributions. These adjustments reduce your gross income to arrive at your adjusted gross income, or AGI. Now, your AGI is a super important number. It's like the cornerstone of your tax return. Many tax credits and deductions are based on your AGI. For example, certain medical expense deductions are only allowed if they exceed a certain percentage of your AGI. So, the lower your AGI, the more potential benefits you might qualify for. Keep that in mind. Next, we subtract deductions. This is where you have a choice: the standard deduction or itemized deductions. The standard deduction is a flat amount based on your filing status: single, married, filing jointly, etc. It's like the easy button of deductions. For 2024, these numbers are readily available on the IRS website, and they change yearly. Itemized deductions, on the other hand, are a bit more involved. You add up all your eligible expenses, things like state and local taxes up to a limit, mortgage interest, and charitable contributions. If the total of your itemized deductions is higher than your standard deduction, you'd choose to itemize. If not, you take the standard deduction. It's all about whichever saves you more money. So, you've subtracted either your standard or itemized deductions from your AGI. What you're left with is your taxable income. This is the golden number, the amount that's actually used to calculate your tax liability based on the tax rate schedules. It's the foundation upon which your tax bill is built. It's important to understand your taxable income to know how to file. Finally, after calculating your tax, you may be able to subtract what are called tax credits. Unlike deductions, which reduce the amount of income that's taxed, tax credits directly reduce the amount of tax you owe, dollar for dollar. They're like a gift card to the IRS. A common example is the child tax credit, which can significantly reduce the tax burden for families with qualifying children. Your total tax, then, is your tax liability minus any credits you qualify for. Then, your total payments are calculated, and a refund or amount owed is calculated. So, how does understanding this whole tax formula empower you? Well, it allows you to make informed decisions. For example, if you know that contributing to a traditional IRA reduces your AGI and that lower AGI might make you eligible for certain credits, you might be more motivated to save for retirement. And which part of the formula do you think is most confusing for beginners? I'd wager it's the choice between standard and itemized deductions. It really requires looking at your individual expenses and doing the math. Here's your call to action for today. Grab an online tax calculator. There are tons of free ones available, or fire up your tax software. Play around with different scenarios. Change your income, add some adjustments, try both the standard and itemized deductions. See how the numbers change. Seeing the formula in action, with your own potential numbers, is the best way to truly grasp it. Remember, forms like Form W-2 help calculate your wages and salaries. It's empowering to understand the process, and it can help you make smarter financial choices all year round. Key takeaways: the tax formula is a step-by-step process. Gross income minus adjustments equals AGI. AGI minus deductions equals taxable income. AGI is a crucial number, and choosing between the standard and itemized deductions is a key decision. Tax credits directly reduce your tax liability. Understanding the formula empowers you. And that's a wrap on today's deep dive into understanding your income. We covered a lot of ground, starting with the core concept of gross income. Remember, that's essentially income from whatever source derived, so almost anything of value you receive counts. We then explored those important tax exclusions, which are the exceptions to the rule, like certain health benefits and veterans benefits. One of the most impactful parts of today's discussion, I think, was walking through the income tax formula. understanding how gross income gets whittled down to taxable income through adjustments, deductions, and finally, how tax credits can reduce your tax liability. That's powerful knowledge. It really demystifies the whole process. We even touched upon how to use documents like your Form W-2 to assist you. Don't forget those tax rate schedules. We also touched upon how to calculate and report your wages and salaries as income. This episode was filled with income tax basics. Hopefully, you're now feeling much more confident in your ability to embrace mastery of cash flow, as we like to say here at Safe Simple Sound. Remember, understanding your financial choices, particularly around income and taxes, is a huge step towards seizing financial control. Thank you so much for tuning in to the Safe Simple Sound Tax Edition podcast. I truly appreciate your time and your commitment to building a stronger financial foundation. If you found this episode helpful, please consider subscribing to the podcast and leaving us a review. It really helps others find the show. And be sure to check out the show notes for links to the article we discussed today, Decoding Your Income, a beginner's guide to understanding income fundamentals, as well as other helpful resources. Until next time, stay informed, stay proactive, and keep making those safe, simple, and sound financial decisions. This is Alex, signing off.